Hi, my name is Rod Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled that you're here. And I know you're going to get tremendous value from the gentleman we're interviewing today. His name is John Griggs, and he's the co-founder and co-CEO of the Presidium Group. They've got over 13,000 apartment units, a lot of land that they're developing or going to develop. And so we're going to have a lot of fun today talking about all that. John, welcome to the show, bud.
Hey, thanks so much, Rod. Great to be here.
Yeah, let's have some fun today. So why don't you start, as we always do, by just giving us a little background on you and the Presidium Group, how you got into this business, maybe where you came from initially, and just a little bit of your progression, if you don't mind.
Yeah, absolutely. So I started out as a lawyer back about 24 years ago. I was a lawyer in California, and was kind of, looking for something entrepreneurial, really like practicing law and like the mental challenge of it, but was looking for something where I could really be the prime mover and really be driving things instead of being sort of an ancillary part of it. And so a good friend of mine from law school and I, kind of looked at a bunch of entrepreneurial options kind of in the early 2000s and settled on real estate. It's something that we understood. We liked it. I love touching the bricks and mortar and the bricks and the sticks. And it's just something tangible that is valuable. And so we started buying small apartment buildings in Phoenix in 2003, just with our own money, bought a bunch of fourplexes, went long on real estate, financed them very aggressively as you could back then. And then the market soared from Arizona became a darling from 03 to 05. It really doubled in value without a ton of rent growth, but just kind of Californians discovered this place. And so we were sitting on a nice situation there where we had our equity had basically got 5x. So we sold everything in 05. Just wanted to realize
You lucky SOB. You talk about good timing. All right, good.
Yeah, we also went through the downturn in Texas, which it happens. So we took we took our profits from there and started raising outside capital and getting debt and equity and buying larger buildings, starting out in Dallas and then in Houston, and got up to about 5,000 units before
on your own or syndicating?
Syndicated. So
Gotcha.
We had friends and family. We had some private equity groups and a couple large family offices. So it was a mix. But great investors. All
so you got to 5,000. Sorry, I interrupted you, buddy. Forgive me.
No, we got to 5,000. And then kind of right before the downturn hit, we had been outsourcing property management, which is something you have to do if you're growing and at a relatively small scale. But we saw that we weren't kind of hitting our pro formas and expenses were always a little higher than they should be. So we brought property management in-house kind of right before the downturn, which I think turned out to be a real blessing in disguise. Then the downturn hit and we battled through it and got through it and did okay. And really just spent 3 or 4 years focusing on operations and how to make $1 out of 98 cents and how to battle through it. And in retrospect, I think in that downturn, being in Texas is probably one of the better geographies. Being in multifamily is probably one of the better asset classes. So we did fine and got through it. But really learned some valuable lessons about, always kind of stress test your model and stress test your assumptions. What happens if you're not 94% occupied and you're not raising rents 3% a year and, limited concessions? Because sometimes, that happens. So got to the end of that and then kind of re-upped and really went great guns on the value add multifamily side and acquired about 10,000 units between 2012 and 2016. My partner moved to Austin, so I'm here in Dallas. He's in Austin, and really focused on DFW, Austin, Houston, San Antonio, and built out our current portfolio, which is about 13,000 apartment units.
And you're at 15,000. Wow. And so I saw you're in Florida, Arizona, and Maine as well. But the bulk of your portfolio then is in Texas because that's where you guys are.
Yes.
It is now. Yeah. Although we have expanded those other states. So, and I expect to do quite a bit more where you are in Florida.
Yeah. Oh, we love Florida. 80 million baby boomers getting old and getting cold, right? So that was my line pre 2008.
I like that. I'll take
that. So you did value add, and obviously you've been very, very successful on the value add front. But let's pivot to development, because I know you've got quite a bit of land in Austin. Oh, good Lord, you're in a fantastic position in Austin with land, as you know. I don't have to tell you that, but Dallas and Houston as well. So you've got like 104? I have hundreds of acres, is what I'm seeing. Yes, is that correct?
Yeah. Well, at this point, we do. Yeah.
Wow.
And so one thing that we did kind of as the value add cycle kind of rolled on, we deliberately set up a development arm about 5 years ago, and so we staffed it up and we started to acquire sites and started building apartments. And over the last few years, we've built or have under construction 10 different complexes. About 3,000 units in total. So,
wow. Primarily HUD financed or all over the board as far as financing?
Some HUD finance, some bank debt, some kind of aggressive stretch senior loans that'll get higher in the capital stack. But that's really what we've been focused on. So there's a couple major things we're doing now. One is kind of the, call it 1 or 2 phase apartment buildings, and we're doing those all over DFW and in Austin, Jacksonville, Florida. We've actually built 2 projects there, and
wow.
Have another 3 in the pipeline, and are looking to get in Tampa, St. Pete, Sarasota, where you sit, which is just about one of the best markets in the country right now. And Phoenix as well would be another logical step. But so we're doing a lot of these one-off kind of apartment buildings. And then we also have a couple large master plan projects near Austin that we're programming for large scale mixed use, kind of multifamily, and then office and retail as well. And those are big projects.
Wow. So I want to drill down on it a little bit, but you know what? I jumped ahead too fast. I because of COVID and, my belief that at some point here, we're going to have a correction. Real estate goes through cycles. You've seen 1 or 2 of them. I've seen several. I think I'm a little older than you. And I've gone through some real downturns back in the late 80s and the SNL thing and things of that nature. With that in mind, let's talk about some of the strategies, and I want to come back to development. Forgive me that I'm bouncing around a little bit. With that in mind, what did you do operationally? And I agree with you. If you took the management in-house, that's absolutely a home run, especially, you're not relying on other people. It's so much more challenging as we've experienced. So what did you do when you focused on ops? I know there's a lot of common sense component to this, but just talk about some of the things that you did back in 2008, if you can recall, that helped you weather that storm.
Yeah. I think there's just sort of kind of big picture is when you're operating an asset, when you're the manager, you see everything. When you're using third-party management, and again, there's no knock on it. There's some great managers out there.
Oh, sure.
Definitely. And early on, it makes sense to do it.
Right.
But you're really looking in the rearview mirror. You're getting a set of financials on the 15th or the 20th that are, 45, 50 days old. And so when you're asking questions about why is this cost higher than it should be, why is income lower here? You're getting answers that are a month and a half old, and you can't really adjust the course in real time. And so when you take it over and do it yourself, you see the bills come in. You're talking to people on site. You're finding out what's happening kind of as it happens. And that's just a big advantage, especially kind of in a downturn, which is a market that's, dynamic kind of in reverse, right? Where things kind of keep getting a little worse every month. Right. And so better to know sooner than later before you're really in a hole. So I think that timing aspect's part of it. But really the other thing that's good is at the site level, having that kind of top to bottom chain of command, where when you walk in the office, when I walk in the office as the CEO, people would recognize, John's the leader of the company, not John's kind of an investor who contracted with my real boss, and we kind of want to do right by him and make him happy, but I don't really work for him. And it's a little convoluted. So when you streamline that chain of command, you just get better results, and you can motivate your people better. And if you're inclined to be somebody that wants to build an organization and really have that corporate culture, you have that unified organization. It just makes it easier.
And guys, what he's talking about, just to clarify, because it even confused me for a second. He's talking about the difference between, walking in with a third party property management company where they're actually employed by that third party property management company. Yeah, he owns the property, but I work for this person, versus you walk in and yes, I work for this, I work for John and I'm going to do what John asks, and that chain of command. Right. So just to clarify, because I wanted to make sure my listeners got that. And it makes a huge difference, absolute huge difference. I'm encountering that on one asset we've got with third party property management right now, where, I know that they tell the people not to talk to me and not to, the boots on the ground, the maintenance people. I'm like, come on, I need to know what's going on. They're afraid to talk because they might get in trouble if they say the wrong thing. And, it's just a pain. Okay. So operationally, you've got that chain of command. Anything else come to mind? Any other little tips or tricks as it related to your operations going through that tough time? The increased vacancy, the tough time with rent collections, people losing their jobs. Any other strategies?
Yeah, I mean, certainly on the collection side, we were prepared for this in COVID, and it happened in some assets, but not most of them. But you're really just getting ahead of if rents are dropping and if concessions are going up, not to be behind that curve. I mean, you really want to see if your neighbors are doing 6 weeks free, you can't be too proud and sort of stick at 2 or 4. You're just not going to get the leases. And you can't be too proud to drop your rents. I mean, you need to sort of meet the market and sometimes even get more aggressive on that side. And again, having that real-time knowledge makes you, and there's a lot of technology that can aid in that now. It's gotten certainly a lot more sophisticated on that side. But staying in touch with the market, making sure you can pivot quickly. And on the collection side.
On new leasing, what about existing tenants?
Yeah, I mean, really, it's service. I mean, the number one reason people move, it's not for money, it's for service. If you're not keeping, your work orders down and keeping your tenants happy and communicating with them, they'll leave. They get sick of things breaking and not getting fixed. So it's as simple as that. I mean, it's really it's not a very, sexy or esoteric concept. It's just like, make sure your stuff works. And if something breaks and the tenant comes in, make sure they get attended to. Yeah. And they have somebody to call and they know that they're going to be responded to. And that's really the key thing for tenant retention. But also look, if you're in a soft market, you can't push through rent increases. I mean, people don't necessarily move because of money as much as they do for service, but they will if you're too aggressive. So you got to kind of maintain that balance. You want to, in a good market, push it obviously and drive that revenue. But if things are soft or weird like they were last year in a lot of ways, just hold off for a little bit, wait a couple months for what you might want.
Yeah, of course, yeah. And we're seeing, I don't know how you feel about the future. Well, let's ask. Let me find out. How do you feel about the future? I mean, how do you feel about the trillions of dollars that they're throwing into this economy? Do you have any inflationary concerns or what are your thoughts about what could happen? What's your crystal ball?
I've been, no crystal ball. I've actually done some fixed rate mortgages, which means I've been wrong about interest rates before. So, interest rates have been going down for 30 years here and it's been just a secular trend. To your point, look, we're putting a lot of money into the economy. A lot of economists think there will be some transitory inflation, and then it levels out again. That's totally possible, and that's fine for multifamily. If there is real inflation, having hard assets with a fixed dollar debt attached to it, that's a good spot to be in.
Really good spot, yeah.
Really good spot to be in, and if there's inflation, there's going to be rent inflation. So I'm not. Unless we're kind of in a 1970s scenario, which I really don't foresee, because I think there's some things happening now. Technology is really driving a disinflationary kind of trend, and there's also greater sort of trade, and I think immigration is going to pick up again, and those things really help with inflation. So I don't see it getting out of hand, but it's certainly going to be something to watch. But look, hard assets. They're not making any more of it, right? I mean, literally, real estate is a great hedge against those things. So,
absolutely. I've had economists on the show, and they've all said the best thing you can be in is either cash or cash flowing assets like real estate, and multifamily is fantastic for that. All right, super. Well, let's circle back to development. So maybe you can talk about, pretend you don't know anything about it, or you did, when you first started, if someone's thinking, yeah, I'd love to build a few units, I'd love to build a 20-unit to townhouse arrangement or something like that. What do you look for? What do you do? How do you, just drill down on that a little bit, if you would.
Yeah, absolutely. I mean, location, it's a cliche, but it's absolutely true. I mean, and especially for development. I mean, you want to be near jobs, near retail, near amenities. Hopefully, preferably have some visibility on a main road where people are going to see your projects coming out of the ground. Those are the key things. And in markets in the Southwest and Texas and Southeast, there's a lot of places that qualify. I mean, when you have kind of, to your point about the boomers and or just people moving to Texas or Arizona, I mean, you're taking orders for the most part. I mean, the people are coming to you, so it's a little easier. But yeah, find a good location and really try to deliver the best development you can. Be a little bit better than everybody else, and you'll be resilient that way. It'll help you lease.
Interesting. So what about like getting a little more micro? Do you try to increase the density when you go buy a piece of property? Do you try to? But what I mean by that, guys, is where you can put more units on a parcel. Do you get into that? Do you get into zoning situations, things like that? Yeah,
we do. We've done many. I mean, we've done a bunch of zoning. Generally in Texas and Florida, it's a lot of municipalities are pretty pro growth. So although that's changing a little bit, so it's something to be cognizant about. So yeah, we're doing rezonings. Our view is you want to put as much on the asset as you can because the land's a fixed price. We were not big fans of structured parking. That adds a lot of cost. So if you can do a surface park product in a suburb, I mean, that's pretty much ideal. But the good thing about development is, we're going in and building really top of the market, top quality stuff for, call it 160 to 170,000 a door surface park. And that product in Texas will sell for 200 right now.
Wow.
In Florida, it can sometimes sell for 220 and more, certainly, in your area, Rod, I mean, way more. So there's an embedded margin. The flip side to that embedded margin is the realization is going to be 3 or 4 years out. So you have to build it and not screw it up. That's important. Right. And you got to have great contractors and all that.
And so how do you do that? Do you have your own architects in house, or do you, architect is the first piece, isn't it? I mean, architectural.
Yeah. Right. No, it is. So architect and land planners, we engage third parties for that who are really kind of in the market every day on that side and see best practices. Okay. But we are the developer. I mean, so we engage the architects, the engineers, the land planners. We oversee.
So you're the general contractor, as it were.
We're not that either. So,
you're not. You're just you're the developer. You're developing the land. Okay.
Yep.
Okay.
So it's something we think about as we get bigger. But
being a GC, yeah. Okay.
Yeah, it's a logical next step. But for now, I mean, we have some great relationships with GCs, and I mean, and they've got the buying power. I mean, especially with costs today and labor today, that's important.
Big, large national construction companies. Is that what you use? Yeah. Okay.
Yeah, or regional.
Or regional. Gotcha. Okay. And I mean, where was I going to go with this? Really, with the the potential for a pullback. How do you stress test a development deal? I know for us on a value add deal, we'll look at break even day one, then we look at break even after we refinance, and we want to see, a nice little spread there as far as economic occupancy. What do you do on a development deal to stress test it? Just curious.
Yeah, no, I mean, it's somewhat of the same analysis. I mean, you're really, the velocity of leasing is important. What if leasing slows down? Right. And then how much can you lower rents if you're going pro forma at 160, do you survive at 150? If you don't, you probably shouldn't.
Means per square foot, guys. He's talking
exactly.
per square
foot. Yeah. Mm-hmm. But you need, I mean, if you need to hit 30 leases a month and you're dead in the water, if you do 25, you shouldn't do that deal either. I mean, you need, because development it's high stakes. I mean, with a value add asset, you at least have a rent roll that you inherit. So if it's slower, that's not good, but life goes on. You've got recurring revenue. With development, you've got to have some margin there that can compress on the rent and the occupancy side, and you still make it out. So we look at that for sure.
Can you speak to why you would use different types of debt in your different development projects? I mean, I know HUD's got fantastic high loan to value, long-term fixed debt. Why would you not use HUD every time? Can you speak to financing just a little bit?
Yeah. So HUD is great. I mean, we've used it several times. It takes a while. So it takes about 9 months to a year to place. So you need to either own the land or have a nice long contract period. Have a patient seller. So, but it is great that once you get it, the interest rate's fixed for 40 years. It's fully amortizing. There is a stiff prepayment penalty. So if you want to sell in years 1 through 5, say it might not be the best, but you can play with that too. So HUD's a great option. There's a lot of administrative.
Oh yeah, there's that whole back end process.
Oh yeah,
the pain in the butt.
I would definitely recommend find a lender that's done a lot of them, because they'll sort of shepherd you through.
Maybe even a partner if it's your first one. Yes, that's done.
Definitely, yeah, no, because it's mind numbing. It's a lot of stuff.
Right.
And then the other two ways are bank debt, which will be lower leverage at kind of 65% loan to cost, and then you need more equity. You can have preferred equity, but you need more equity. Or there's lenders out there that'll go to kind of 80% loan to cost at more like a 6 or 7% interest rate, but you can get them out of there in 3 years. So once you build and stabilize, you can sell. You don't have a prepayment penalty, and you can sell or refinance without that. So we've done kind of all three, and it largely depends on who our equity partner is and what their appetite is.
Oh, and what their the longevity appetite they have as well. Yes, and to be in the deal.
Right. That's right. Yeah. A lot of folks are, they want to get out quickly.
I see. Interesting. I'm a big advocate for legacy property, and in my podcast is called Lifetime Cash Flow. And I told you about my first interview, Albert, and how he calls himself a real estate buyer, not a seller. He hates selling. What's your thought process on what I just said?
Yeah, look, I mean, it's funny. We're kind of a hybrid. I mean, we have 13,000 units that we've bought and have recapped and refinanced and
you're holding those. You're holding, just keeping an eye on those submarkets. Make sure they're not declining, and if they don't, you're in for the long haul. Okay, exactly.
Gotcha. And when you're in a good product in the infill location or a thriving area, you can do that. And Fannie and Freddie and HUD offer really good refinance options that, once you get your NOI up, you can refinance and put yourself in a good situation to be there for a while. I mean, to your point, the tax benefits, the cash flow, it's a good situation.
Refi, get your investors their money back, and then the returns are infinity. Yes,
exactly. Everybody's happy once you do that. That's right. And that's sort of the goal, is to get that done in the first 3 years. For sure.
Love it. So let me ask you this, buddy. I mean, you have amazing success. What's the driver? What's the why? What gets you to jump out of bed in the morning? Just talk about that a little bit, because my podcast is done really well because of the whole mindset component. And my belief that 80 to 90% of a person's success in anything is really their mindset and their psychology. Can you speak to what's driving you?
Yeah, no, it's a good point. I mean, I've really come to the realization, it's sort of a basic thing that a lot of people talk about, but you got to love what you do, right? When I was a lawyer, I'll just, to be candid, I didn't really love what I did. I got out of bed every day and I pushed myself and drank some coffee and I got it done. I was a professional and I think I did fine, but there wasn't that passion. And when you're starting your own company and when it's late at night and you've got things to do, when you've got stressful challenges in your operation, whatever it is, physical challenges, your property, economic challenges, personnel issues, you gotta be fully invested. You gotta be all in on it, or you're gonna get sick of it. So fortunately, real estate is such a fun business. I mean, it's a people business. It's a place business. It's a touch and feel business. No day is really the same. And so you're just energized. If you're in multiple cities, you're out there in the community in different areas, and you're seeing these places change dynamically. It's fun. And if you love it, it's not really work. And so it's such a cliche, and it's so
true.
It's so true. It's 100% true. You got to love it. And so you get fired up to do it, and you have some success, and it feeds on itself. And the other thing is you don't know what you don't know, and I didn't know everything about this business when I started. No one does. And looking back, I learned a lot, and I made mistakes, and I for sure. I didn't know what I didn't know, right? To paraphrase the Rumsfeld quote, but now after 17 years, I feel like I do, and I should after that long.
Right.
And now it's a different level where you're executing, you're driving. I learn stuff every day, but you get to a point where it is rewarding when you feel like you're an expert in your area and your geography, and that's what your investors are looking for. They want you to be the expert. They're investing with you because you know more about this product type and this geography than anybody else. And just that's the key.
No, for sure. And guys, if you're going to do this, you need to become an expert in your submarket, your market. There's just no question. You don't dabble in this thing. Well, let me ask you this: when you were starting out, were there any aha moments for you? Any were like, holy cow, now I know this is what I need to do, or anything come to mind when I ask that question?
Yeah. I mean, the one sort of, and we learned this over time. And then when we really went kind of full bore on renovations and after, kind of 7 or 8 years of this, one key lesson is don't skimp on the value add scope. I mean, if a property's got issues that need to be fixed, go in and fix them. I mean, don't, if the boiler isn't working that great, don't plan for that in year 4 and hope you just kind of, hope and pray for 3 years.
Right.
Go and fix everything. Go make it really good day one. And frankly, I wouldn't depend on cash flow to fuel your renovations as much either. I mean, if you're lucky and you don't need all the money that you've set aside for renovations, that's great. You can always distribute it back to everybody. You'll be a hero. People will be thrilled. They say, wow, this guy really, he was cautious. If you're under budget and you need to make a capital call 3 years in, that's not going to go over quite as well.
Right. That's no fun. Yeah.
That's no fun. So be ready. And look, if the market soars and you're covering all your costs through cash flow, that's great. But go in and fix all the problems, make your product the best in the submarket, and have the capital ready for that kind of at the outset.
Nice. So what words of wisdom would you share with the aspiring commercial real estate investors on my show? The ones that maybe have some houses, some duplexes, some fourplexes. They know they want to go larger. They haven't pulled the trigger yet for whatever reason, fear of failure, fear of whatever. What would you tell them?
Yeah, I mean, there's a couple of things. I mean, one is, you got to really focus on this. And if it's not a full-time job, it's got to be something that you spend a fair amount of time on. Because once you make the move from, and I've done that, from single family or fourplexes, you're operating, there's an operating business there that you're in charge of. And it's time consuming. Now, once you get to a certain scale, you're going to have lieutenants that handle a lot of those things for you. But my advice would be, before you hire those lieutenants, do all the jobs yourself and learn how it all works. So then, you can oversee people and what they're doing, and what their actual responsibilities are. So
great advice.
It's a quantum leap to go from kind of the single family fourplex world to the true kind of, large
syndication. Yeah.
Yeah.
Drinking through a fire hose. What would you say is the best advice you've ever gotten about this business?
Again, something real basic, but be honest and be fair with people. and there's certainly a karma aspect to that, but there's also a practical aspect to that too. This is Tampa St. Pete has 4 million people. DFW has 8 million. You and I probably run into the same people all the time in this business.
It's a small world. It's a small freaking world. You think it's big, but it's not. Yep. Screw people over. It's going to get out there. They're going to hear about it. That's where you're going with that, right? Yeah.
Absolutely. So be fair in your transactions. I mean, look, if a seller's hiding a major foundation issue and you find it, your pro forma changed $500,000. Okay, fair enough. But if you're driving by this place and it needs paint, don't go to the guy on day 29 and due diligence say, "Oh, I didn't budget for paint." Be fair. Go in and try to be good on the buy side, because it's a small world. Brokers, the small number of brokers, they talk about folks all the time. Small number of owners, and be fair to your vendors. I mean, do the right thing and obviously try to maximize your profit, but you're going to run into people all the time in this business.
Yeah. Over and over again. And I mean, any one of those can make you wealthy. One broker can make you wealthy. One property management company referring you deals can make you wealthy. Yes. It's just like, don't cut off your nose to spite your face, sort of a thing. So, I love to ask this question, most of my guests, which is, if you could go back and tell your 20-year-old self something about this business, knowing what you know now, what might you have done differently, if anything?
Yeah, I mean, I think it's a few things. I mean, one is to always, kind of plan big on your innovations. Like absolutely do a good job there. When you're buying a property, I mean, you gotta make sure the pro forma works. But if you find a good piece of real estate, and you got to pay a little bit more for it for a really good piece of real estate, sometimes you got to do that. And you got to make sure the debt and the equity, it all works out. But I mean, I can think back to examples in the downturn in 2012 where
deals you could have capitalized on that you passed because you were scared or whatever. Yeah.
We're negotiating in a contract. They want 22,000 a door and I'm not going past 21. Well, now the thing's worth 100. I wish I did that deal. Yes, I would. But there's plenty of those.
Gotcha. So who inspires you? Do you have any heroes either in the business or outside of the business that you're like, wow, that's so freaking impressive, or who they are or what they stand for? Anybody come to mind when I ask that question?
I mean, it's a whole host of folks. I mean, I sort of look at this as kind of a big team sport, ranging from, my family to my friends to folks in the business who are leaders, other owners and brokers and folks, frankly, on your side who are getting the word out to enable, this sort of revolution in investing where the individual investor really is participating like they never have before. But it's such a dynamic business with so many personalities. I love talking to as many people as I can and listening to their stories, because everybody really adds something. I mean, it's a fun group.
Nice. What's your website? Is it Presidium.com or what is it?
Yeah, it's PresidiumRE.com.
Gotcha. Okay. And is there any question that you wish I would have asked you that I didn't about the business that you think might help my listeners? Any last parting words of wisdom for either aspiring or even successful multifamily investors?
Yeah, I mean, not really. No, I mean, this was a great podcast as always.
Well, thank you. Well, listen, it's been a real treat to meet you, John. Very incredibly impressive what you've done in the amount of time that you've done it, and I really appreciate you taking the time out of your incredibly busy schedule to spend a little time with us today. So, thank you.
Absolutely, thank you, Rod. No, I appreciate it.
Take care.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.